The primary focus is the team actually working to drive value and building the businesses and then moving to exit within the portfolio companies.
Hello, you're watching Proactive. I'm joined by Frontier IP Group CEO Neil Crabb. Neil, very good to speak with you. You're out with your annual results and also news of a £3 million placing and subscription as well as a retail offer. Let's start with the results because you made a lot of progress despite challenging financial markets.
I think it's certainly true that markets continue to be challenging, although there is some evidence that they're beginning to at least soften or improve slightly. So turning to our results, we saw a modest gain on the value of the portfolio, which against the backdrop of, I think, still falling venture prices generally across the market was a good relative performance. Obviously, we have our own running costs as well. So that mapped to a bottom line loss, but significantly reduced from the prior year. But against that was some very encouraging progress in the portfolio. We've seen 3 fundraisings close even since the year end in portfolio companies. So I think that points to some improvement in market conditions. And I think that's driven primarily by the interest rate cycle beginning to turn, inflation beginning to come down, and people feeling a little bit more optimistic about the direction of travel. Although I wouldn't say that there's some dancing in the streets, it's still a fairly tough environment out there.
So let's chat about the portfolio because you have a very good mix of companies, different stages of maturity, several approaching the point where you're considering how you're going to realize value from those. So take us through, you mentioned a few of them in the results. So maybe starting with Pulsive, strengthened its board, new chairman and chief products officer, and also the new reference design for its charger.
Yeah, so just generally to your point about the stage of the portfolio, 3/4 of the value now sits in the stage that we call scale up, which comes before exit, which I think is really important. It takes 10 years for these companies to get roughly from start to end. But of course, we've got many companies in the portfolio that are well along in that journey. Pulsive is a good example where the backdrop to this is that Pulsive is focused on power conversion. And power conversion is something that is very inefficient currently. So more than half of the generated electricity doesn't do useful work in end devices. It's lost in transmission and conversion through the process. There is a move to standardize on, and I'm sure your listeners will be familiar with this, USB-C charging. So traditionally, we're used to carrying around a bag full of power converters and chargers. And the EU in particular, but others are following, have got on top of this and said, actually, there must be a standardization. And that standardization is on this thing called USB-C, which is just a standard plug into your phone or laptop. Pulsive have come out with what we believe to be the most efficient converter for delivering that charging solution to take mains power and convert it all the way up to 240 watt onto the power that's used by your device. And the innovation there is around not just more efficient conversion, but linked to that, less heat generation. Heat is a really big issue when you try and implement these solutions, and potentially a lower bill of materials as well for the companies making the devices. That's had global interest. There's been global appointment of distributors. Big trade show last week, which got a very, very strong response. And we're now looking for news to come through, or shareholders will be looking for news to come through on customers as that story builds out in 2025.
Yeah, another company that made progress, Cambridge Raman Imaging, started sales of its high-speed lasers. So good progress there. And you could also maybe touch on Nandi Proteins, another one that you mentioned in the results.
Yeah, so taking CRI first. So that commenced sales last year. This year is seeing a significant growth in that rate of sales, which is really encouraging, and a broadening out to working with industrial partners. Originally, they were selling into research groups. So that commercial ramp is super important. It's in the area of enabling label-free imaging. So basically, you can scan, for example, a cancer biopsy, and instead of the traditional approach of staining the cells and having a human expert read it, you can have a laser system read it and then apply AI to get to an initial diagnosis. And that's a more efficient, more cost-effective, and potentially more reliable method. But it has application beyond cancer diagnosis into drug discovery and such like. Nandi also at the stage of commercial rollout. So we signed our first commercial licensing partner that's also handling the manufacturing this year, and we expect to see product on the market early next year to end customers. So people eating food with the Nandi ingredients in it, which obviously is what it's all about. And again, targeting really large markets in that case, because the processed food industry is big. Once you roll out, the volume should build really quite quickly. So we think that is also encouraging.
Okay. And another portfolio company that did make progress, CamGraphic, progress with its graphene photonics. Maybe a quick word on that, please, Neil.
Yeah. So semiconductor space is really interesting. It's become politically very sensitive, of course, with CHIPS Acts being passed in the US, the UK, the EU, Japan, as each of those trading blocks tries to build up domestic capacity in high-end chips. And we've seen the growth of AI, the performance of NVIDIA and such like, driving demand for more and more processing power. So everybody's trying to put in place the building blocks of those and recognizing that they are something that you want some domestic control over in each of those trading blocks. The challenge is that we're coming to the end of Moore's law to deliver continuous improvement from just straight silicon, and graphene potentially enables that because you can put graphene into silicon chips and therefore improve the performance, particularly around the photonic space. So the other thing that's happening is that for infrastructure, there's a move away from moving electrons to moving photons to move data around, and that's because photons require less energy, and basically you can move more of them through a single medium. You can put multiple frequencies of light, whereas you can't put multiple streams of electrons. So Cambridge Graphene Centre has been a real enabler in some of the base material science. People will know that graphene was a material discovered in the UK, also working in Italy, where we have a strong team. And essentially that's addressing this insatiable need of the industry for faster data movement at lower cost and using less energy. I mean, those are the drivers. And graphene as a new material coming into the silicon infrastructure enables a significant improvement in the level of performance.
Neil, also at the group level, you made some changes during the course of the year. So strengthening your board, you have a new chair as well as a new chief financial officer in the management team.
Yeah, so Joe Stent joined us as new CFO, Jim having moved towards retirement. He's actually still with us working with portfolio companies, but Joe's come in and brought a really broad breadth of experience. And we were delighted as well that Julia came on board, Rannis Brown of Cambridge, as our chair. She's run a university, chairs the Science and Technology Committee in the House of Lords, chairs the Carbon Trust, and importantly has invested significantly as well in the round that we've just announced. So very much not just a figurehead, but actively supporting the business, both financially and, of course, with her broad connection base.
I mean, let's talk about the round that you've just announced, because you've raised £3 million through the placing and subscription. You also have a retail offer, which is closing this evening. How do you plan to use those funds to support the company, but also support your portfolio companies?
Yeah, so in the period that we've just come out of, it would be fair to say we provided a bit more financial support than we had expected of the portfolio companies, reflecting that dislocation in the market that was exacerbated when we saw the surge in interest rates and in inflation. That, as I flagged, I think is softening. So the bulk of the use of the funds is to support our team or fund our team that is helping these companies commercialize, and where we're seeing them, obviously, as I've flagged, coming to market and the realization phase, that will create a stream of extra work. We'll selectively be supportive of the portfolio companies, I guess, but that's not the primary focus. The primary focus is the team actually working to drive value and building the businesses and then moving to exit within the portfolio companies.
Neil, I hope you'll keep us updated on any additional progress. Thank you very much for speaking with us today.
Thank you.
That's Frontier IP Group CEO Neil Crabb.